Hi, I'm Matt Greaves, Marketing Manager at SWAT UK. Thanks for joining us today. Today we're joined by Andy Holton, Divisional Director of Publications.
Hello, Matt.
Andy, thanks again for joining us today.
My pleasure.
So today we're talking about the move to FRS 102 and in particular the problem associated with loans. So is this a problem that's across the board of all loans, Andy, or is it just specific loans that's causing a problem in relation to the move to FRS 102?
Yeah, it's only some loans that are causing a problem. So bank loans or other loans that are at a commercial rate of interest, and where that rate of interest is determined in a basic, or is expressed in basic terms, they're not a problem because you can just account for those loans at amortised cost, which is pretty much what we do at the moment. It's where that's not the case that these loans can cause problems.
Okay, and what do you mean in terms of basic terms?
It's to do with how the interest rate is specified in the loan agreement. So if an interest rate is set at, say, a bank's base rate or a bank's base rate plus 2% or something like that, then that's quite easy to see the rate of interest that will apply. But if the rate is based on another index, a commodity index or something like that, or it's leveraged in some way, so perhaps 2 or 3 times base rate, then that would not be a basic term to the loan, because it may not be possible to determine what the rate of interest is that applies to the loan, and therefore that loan would need to be accounted for at fair value rather than amortised cost, which is different to what we do at the moment.
Okay, and what about loans that are not at a commercial rate of interest? Is there an issue there?
There is, because FRS 102 separates out the financing element of a transaction and looks at that separately. So where a loan is made that is interest free, there is actually 2 elements to that. There's the loan itself, and then there's also the financing of the interest free element of that loan. And right. FRS 102 addresses this by by requiring such loans to be accounted for at net present value of the amount advanced. So for example, if one company lends another £10,000 interest free for 2 years, then the net present value of £10,000 in 2 years' time is roughly £9,000. And the issue is, how do you account for the £1,000 difference? Because essentially the company will take £10,000 out of its bank account, but it will only register a debtor for the loan receivable of £9,000. So what do you do with the difference?
Sure. Okay. Right. Okay. So how do you account for that difference?
Well, unfortunately, that question isn't straightforward, and it very much depends on the relationship between the 2 companies. So, for example, if a parent company makes a loan to a subsidiary, then the parent company has essentially increased its investment in the subsidiary by £1,000. From the subsidiary's perspective, it's received some benefit from the parent, so you would treat that as a capital contribution. Alternatively, if the loan was from the subsidiary to the parent, then the subsidiary has essentially made a distribution to the parent, so you treat it in the same way as a dividend. And then from the parent's perspective, it's received income from the subsidiary, so again you would treat it as a distribution from the subsidiary and treat it much like a dividend.
Right. Okay. So relationships between companies can get more complicated, but presumably this answer sort of helps sort that problem out as well, does it?
It does, but the answer can get more complicated. So as the relationships become more complicated, the answer isn't quite as clear or as simple as I've expressed it. Thankfully, the Institute have recently issued a couple of help sheets on this subject, which give some examples, and the Financial Reporting Council are about to issue one of their staff education notes, which is essentially, as the name suggests, guidance by their staff on particular areas, and that gives a number of examples of how loans should be accounted for where they're not at a commercial rate of interest. So certainly those documents will give a far more comprehensive answer than it's possible to give in a conversation like this.
Sure, yeah. Okay, so quite a complicated area.
Absolutely. And it's complicated in itself, and it's also new. So it's a problem on both fronts.
Yeah, a double whammy, if you like.
Absolutely.
Yeah. Well, FRS 102 in itself is obviously sort of going to be representing a big change over the course of the next 12 months. And at SWOT UK, we've got a whole range of FRS 102 courses running throughout the remainder of 2015 and 2016. You can find out more information on our website at www.swot.co.uk. But for now, Andy, that's been really helpful. Thanks very much.
No, thank you.